Welcome to the deep dive. You've sent us down a pretty interesting rabbit hole this time, a whole bunch of material all about the base oil market.
Yeah.
Our mission today, to kind of boil it all down to the key insights, figure out who the big players are, and get a handle on where this, well, crucial industry is actually heading. Looks like we've got a detailed market research article leading the way.
Exactly. And what jumps out immediately is just the sheer scale, and where it's projected to go. It's already, what, a $19.6 billion market in 2024? That's not small.
Not at all.
But the projection, hitting over $30 billion by 2032, growing at a pretty solid 5.5% each year. That tells you this isn't some niche thing. It's fundamental to the global economy.
Okay, let's maybe unpack the basics first. Base oils. For those of us like me, maybe, whose eyes might glaze over when you say lubricants, these are the core ingredients, right? The stuff that makes engines and machines run smoothly. Everything from cars to huge industrial gear, even ships.
That's it, the backbone, really.
And the article mentions these groups, Group I through V. Can you give us a quick, sort of clear breakdown? What do those actually mean?
Yeah, sure. Think of it like a ladder, maybe, a ladder of refinement and performance. Group I oils, they're the least processed, generally made with, older sulfate-based methods.
Yeah.
Then you climb up to Group 2 and then Group 3, and you're looking at more sophisticated refining, takes out more impurities, leads to better performance, things like a higher viscosity index.
Viscosity index, meaning?
Meaning the oil's thickness stays more consistent, whether it's hot or cold, super important for engines. And lower sulfur content, too, which is better for emissions in modern engines.
Gotcha. Better for the environment.
Right. Then Group 4, those are the true synthetics, engineered for top performance, especially in extreme conditions, hot or cold. And Group V is kind of the catch-all category for other types, naphthenics, ester stuff, with really specific uses.
Right. So basically, a higher group number generally means more advanced, better performing, cleaner oil that fits with the growth projections then. And this research, it teases some surprising demand drivers, like electric vehicles definitely need to circle back to that one. But first, what's actually, powering this market expansion we're seeing? What are the main engines here?
Well, there are several really key factors, and they're kind of interconnected. First, just the basics. Growing global population, growing economy means more vehicles being made. Simple as that. More cars, more lubricants needed.
Makes sense.
But then there's a really significant push from stricter emission standards.
Yeah.
All around the world, these rules basically force automakers to use higher quality lubricants, lubes that can handle tougher engine conditions and ultimately help cut down those emissions.
Ah, so it's not just more cars, but the type of cars needing better fluids to meet environmental rules?
Exactly. And tied right into that is the constant focus on energy efficiency. Those more advanced base oils, especially the Group 3 and 4 synthetics, they play a really big role in getting better fuel economy in cars and also making industrial equipment run more efficiently. The research specifically flags the strong demand in the auto sector for these premium base oils because manufacturers have to make more fuel-efficient, lower-emission vehicles.
Got it. So vehicle, tech, and environmental targets are huge drivers. What about other sectors, industry?
Oh, absolutely. The industrial sector is another massive piece. Think about all the industries using heavy machinery manufacturing, power plants, construction, you name it. They all need high-performance lubricants to keep things running smoothly, efficiently. And the demand there is growing, too.
Okay, so more vehicles, tougher environmental rules, and the drive for efficiency everywhere. That makes sense. Now let's get into the who. Who are the major players actually making this stuff? The research points to a top tier, right?
That's right. The 5 really dominant companies right now, they are Exxon Mobil, Saudi Arabian Oil Co., Aramco PetroChina, Chevron, and China Petrochemical Corporation, which is SINOPEC. These are the established giants, the ones with the biggest production, the biggest market share.
And when you say giants, wow, the numbers really show it. Let's dig into Exxon Mobil first. What does their slice look like?
Yeah, Exxon Mobil, they definitely have a huge presence. In 2023, their total sales were, get this, $338.29 billion. Just staggering.
Wow.
And out of that, $6.8 billion came specifically from base oils. That gives them a market share around 17.5%. That's a really significant chunk of the market.
No kidding. And their production must be huge, too.
Over 3 million metric tons every year. And what's really telling is that a big portion, 65%, is that premium synthetic stuff we talked about, really shows that shift towards higher quality.
Yeah, definitely reinforces that trend.
And what's interesting is their focus on their own tech.
No.
Their EHC Group 2 and Spectracin Group 3 oils get mentioned specifically for like high viscosity index,
Oh,
low volatility, meaning they don't evaporate easily, and really good thermal stability.
yeah.
Crucial for high temp operations.
So proprietary tech is a big advantage.
Seems like it. And they're not standing still. They introduced bio-based base oils in 2023. Shows they're listening to that demand for more sustainable options.
And they're putting serious cash into upgrades too, right? Something about a $500 million investment in Singapore?
Yeah, that refinery upgrade. That directly boosts their ability to make those higher margin premium oils. Smart move, especially for meeting demand in a key region like Southeast Asia. And their long game is clear from their R&D, spending over $1 billion a year.
$1 billion.
Including their advanced lubrication technology program, which is specifically looking at EV lubricants. Remember we mentioned EVs. Even without combustion engines, they still need special fluids, transmissions, battery cooling.
Right.
Exxon Mobil is clearly betting on that future demand, investing in it now.
That's a really good point about the EV fluids. Okay, let's shift to the next behemoth. Saudi Aramco. Their overall revenue is even bigger, isn't it? How does their base oil business stack up?
Yeah, Aramco's total revenue in 2023 was $496 billion. Massive. Their base oil division brought in $5.4 billion, giving them about a 14.8% market share. Still huge. And their annual production, also massive. Over 2.5 million metric tons, again with a big focus on those Group 2 and 3 categories.
And they've got their own brand, Lubrif, known for high quality, low sulfur. That must really help with meeting those environmental regs.
Absolutely. Having a brand recognized for quality and low emissions is a strong position to be in. And just like Exxon Mobil, they're looking ahead too, introducing next-gen synthetics specifically for EVs.
Seen a pattern here.
Definitely. And that $1.2 billion expansion of their Yanbu refinery. Another big signal of commitment to ramping up premium base oil production. Seems like the playbook for the leaders.
It really does. Clear strategy. Invest heavily in capacity for the higher tier stuff.
Exactly. And Aramco's also making a strong push on sustainability, actively developing bio-based and recycled base oils, working with lubricant makers. It's becoming less of a nice-to-have and more of a must-do in this market.
Okay, let's pivot to PetroChina, another absolute giant global energy player. How do their base oil operations compare?
PetroChina's scale is just undeniable. Total sales in 2023, $423.79 billion. Their base oil revenue hit $4.9 billion, putting them at a 13.2% market share. Production-wise, over 2 million metric tons a year. And while they do have Group 1, 2, and 3, there's a clear trend, again, towards boosting their synthetic and bio-based offerings.
And they have their own eco-brand, Green Lube. It seems like having specific product lines for sustainability is becoming a key differentiator, huh?
Precisely. And their strategic focus. Asia-Pacific, you see it in their partnerships in India and Southeast Asia. Those are the booming markets, right? That's where a lot of future growth is.
Makes sense to focus there.
And the $800 million investment to upgrade their Dalian refinery, specifically for premium Group 3, highlights that commitment to moving up the quality ladder again. It's interesting seeing these huge companies make such targeted investments in specific facilities for specific base oil groups.
It really shows a very deliberate, forward-thinking strategy, aligning production with where the market's going. And their R&D sounds notable, too, focusing on EVs, efficient industrial machinery, even working with universities.
Absolutely. Collaborating with universities is a smart way to tap into cutting-edge research, right? Keep that innovation pipeline flowing.
Definitely. Okay, now let's turn to Chevron. Their overall revenue might be a bit lower than some of the others, but still a major force in base oil.
That's right. Chevron reported $194.80 billion total revenue in 2023. Base oils contributed $4.2 billion, giving them a solid 9% market share. Production is over 1.8 million metric tons annually. Again, strong focus on those premium Group 2 and 3 oils.
The research highlights their isode waxing technology. Can you break that down? Why is that a big deal for them?
Yeah, that tech lets Chevron make base oils with ultra-low sulfur content, but also with really exceptional thermal and oxidative stability. Basically, these oils handle heat incredibly well and don't break down easily. Ideal for tough applications needing high performance and durability, their flagship products, like Chevron 100R and 220R, are known for this.
So high-tech refining gives them an edge in performance.
Seems so. And surprise, surprise, they're also moving into the EV market with their Havoline brand, plus developing new stuff for industrial uses. It really seems like every major player sees the writing on the wall regarding EVs and specialized fluids.
Exactly. And that $500 million upgrade to their Pascagoula refinery, another clear investment aimed right at boosting premium base oil capacity. Chevron's tech focus and sustainability efforts seem to position them pretty competitively.
Definitely. Okay, finally, let's look at the last of the top five. China Petrochemical Corporation, or SINOPEC. Another absolute heavyweight, especially in China, but globally too.
What's their base oil footprint look like?
SINOPEC is a production powerhouse, over 2.4 million metric tons annually. They have a pretty balanced portfolio, Group 1, 2, and 3. Their Great Wall series is a well-known brand inside China and out, recognized for performance across different applications.
And let me guess, they've also launched synthetic base oils for EVs.
You got it. It's becoming a standard move, it seems. Their strategic focus, like PetroChina's, is heavily on the fast-growing Asia-Pacific region. That gives them a big advantage. And they've got a multi-year deal with a major Indian lubricant producer, highlighting their push to expand reach in key emerging economies.
Okay, so the picture's pretty clear then. A dominant top five, massive revenues, huge production, and everyone's focusing more on premium oils and future tech like EV fluids. But the research also mentions emerging threats. Who are these companies looking to shake things up?
Yeah, what's interesting is how diverse these challengers are. You've got SK Lubricants from South Korea. They're known for their high-quality Group 3 ZIC brand and a big focus on environmentally friendly products.
ZIC, yeah, I've heard of that.
Then there's PetroChina Lubricants. They have this HT purity process that makes really high purity base oils. And they're also expanding into EV lubricants.
So it's not just about size, but specialized tech, branding, regional strengths.
Precisely. Then you have Germany's H&R OWS Chemie. They're more of a specialist in niche, high-performance base oils and waxes for specific industrial uses. Bahrain Lube Base Oil Company, or BLBOC, they benefit from direct access to crude oil, which can give them a cost edge, and they're strategically boosting their Group 3 production.
Interesting angle with the crude access.
And then there's CNOOC Limited, another major Chinese player with a fully integrated supply chain and an increasing focus on sustainability.
Okay, so what are the key strengths these emerging players are using to try and gain ground?
Well, SK Lubricants, they really shine in that premium quality segment, plus the green branding helps. PetroCanada has its superior purity process and is smart to target new sectors like EVs. H&R OWS Chemie wins by focusing on those specialized high-precision applications. BLBOC's potential cost-effectiveness from crude access, plus their Group 3 expansion, makes them competitive. And CNOC benefits from that integrated operation efficiency, control, plus their growing sustainability focus.
And how are they actually trying to, chip away at the big guys' market share? What are their growth strategies?
Often it's a big emphasis on innovation, developing better oils, more efficient refining. Many are focusing strategically on regional expansion, especially in Asia-Pacific, where demand is really taking off.
Makes sense. Go where the growth is.
And forming strategic partnerships, collaborating with lubricant blenders, other industry players. That really helps expand their reach and find new customers.
So it sounds like they're maybe not trying to compete purely on volume, but more about out-innovating in specific areas, finding niches, and strategically building presence in key regions. Why exactly do these companies pose a legitimate threat to the top five?
Well, because they can often be more agile, more focused. They might adapt quicker to market shifts, embrace new tech without the inertia of a giant corporation. Their specialized products can hit specific needs the big players might overlook.
Right, nimbleness.
And that regional focus lets them build strong local ties, understand market nuances better than a global giant sometimes can. That mix innovation, specialization, strategic focus over time can erode market share, even from the biggest players. It's that classic being nimble and targeted.
That makes perfect sense, sort of a David and Goliath situation where focused strengths can challenge size. The research also gives some pointers for completely new entrants, right? Not just these emerging threats. What are the key guidelines for someone wanting to get into the base oil market today?
Yeah, the advice is pretty solid. First off, you absolutely need a strong focus on developing advanced but still cost-effective base oils, especially Group 2 and 3, to compete in the main market. Continuous innovation is key. Better refining tech, better synthetics for performance, and lower environmental impact. And efficiently sourcing your raw materials. Crucial for controlling costs while keeping quality up.
So cutting-edge tech combined with smart operations.
Exactly. And like we've been saying, sustainability isn't optional anymore. It's becoming a baseline requirement. Targeting those high-growth markets in Asia-Pacific, crucial. Forming strategic partnerships, also crucial for getting in and growing.
Right.
And, critically, any new player have to address the shift to EVs and other new engine tech. You need specialized base oils for those applications. Finally, focusing on customization, offering tailored solutions for specific customers that can be a real competitive edge.
So it sounds like the key for a newcomer is be agile, innovate like crazy, commit to sustainability, and be super strategic about markets and tech trends. The research also briefly revisits how companies in this market are compared or assessed. What are the main things analysts look at?
Yeah, these criteria give a pretty well-rounded view. Revenue and market share obviously show their current standing, but just as important is their product portfolio. The variety, the quality, specific properties like viscosity index, sulfur content. Then there's their track record on tech innovation, their global presence and reach, how much they invest in R&D, and the strength of their alliances and partnerships. All that comes together for a full picture of their competitive strength and future prospects.
So it's not just about current sales, but also their ability to innovate, adapt, and reach customers effectively globally.
Precisely. It's a look at both current performance and long-term potential.
Well, this has been a really fascinating and insightful deep dive into the base oil market. The main takeaway seems clear. It's a big, growing industry driven by global demand and tougher environmental standards. The top players have huge advantages, sure, but there are definitely credible challengers emerging through innovation and smart strategies.
Absolutely. And those rapid advances in EV tech, plus the huge global push for sustainability, they're going to keep reshaping this whole landscape in the coming years. It's definitely not a static market.
Which leads us to our final thought for you, our listener. Thinking about these rapid EV advancements and the increasing focus on sustainability, what might the competitive landscape of the base oil market actually look like in, say, the next decade? Who will the dominant players be? What new tech or approaches could disrupt things? Definitely something to mull over as the auto and industrial worlds keep changing.
Indeed, it raises some really interesting questions about the future of this, well, essential industry.
Thank you for sharing your sources with us and for joining us on this deep dive. Until our next exploration.